Alphabet's operating income is strong, but the drop in total equity is mostly an accounting effect linked to its massive AI-driven capex and share-based compensation, not a collapse in economic value. Why is total equity down? Alphabet is plowing about 185 billion into capital expenditures in 2026, up from $91 billion in 2025, to build data centers and AI infrastructure. These huge capex outlays are financed partly by drawdowns on cash and increased long-term debt, which mechanically reduces shareholders' equity on the balance sheet. Separately, stock-based compensation and large share-based awards show up as charges that reduce retained earnings, another key component of equity, even as operating earnings stay healthy. So the equity decline is not driven by Google losing money in the core business. It's more like the company is moving cash and future earnings into property, plant, equipment, and debt, plus paying executives and employees with stock instead of pure cash. Buffett-style approval would break down into a few big pieces: ROE and moat. Alphabet's ROE is still very high, around mid-30% range in 2025-2026, and Google's ad and cloud franchises are wide-moat, high ROIC businesses. From that angle, Buffett would likely nod. Durable earnings on a relatively small equity base. CapEx versus maintenance CapEx. Buffett prefers light, low-maintenance CapEx businesses, e.g. Coke, Seas. Alphabet's $185 billion CapEx in 2026 looks like heavy growth CapEx to stay in the AI race, which Buffett has historically viewed with caution. In short, Buffett would like the earnings power and ROE, but he would question the scale and permanence of this CapEx and whether management is over-investing in a capital-intensive AI race instead of simply returning cash or buying great businesses.